Ladies and gentlemen, good day and welcome to Neogen Chemicals Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishid Solanki from CDR India. Thank you, and over to you.
Thank you. Good afternoon, everyone, and welcome to Neogen Chemicals Q3 FY22 earnings conference call for analysts and investors. Joining us on the call today are senior members of the management team, including Dr. Harin Kanani, Managing Director, and Mr. Ketan Vyas, Chief Financial Officer. We will commence the call with opening thoughts from the management team, post which we shall open the session for Q&A, where the management will be addressing queries of the participants. Let me leave you with our standard disclaimer. Certain statements made or discussed on the conference call today may be forward-looking statements. The actual results may vary from these forward-looking statements. A detailed disclaimer in this regard is available in Neogen Chemicals Q3 FY22 earnings presentation, which has been shared earlier. I would now like to invite Dr. Harin Kanani to share his perspectives on performance and progress that the company has made. Thank you, and over to you, sir.
Thank you, Nishid. Good afternoon and a warm welcome to everyone on our Q3 FY22 earnings conference call. Our result documents have been shared earlier and available on stock exchange website. I trust you would have got a chance to go through them. I will share my perspectives on the performance, key developments, and outlook going forward. Later, our CFO, Mr. Ketan Vyas, will take you through the financial highlights for the period under review. We reported strong all-round performance during third quarter of the financial year, backed by higher contributions to recent commission phase 1 and 2 greenfield expansion at Dahej SEZ in Gujarat. More importantly, we registered by far our highest ever quarterly revenue of rupees 133 crore in Q3 of FY22, which was in spite of a challenging macro situation. Let me reiterate that this is just the beginning and we have exciting plans lined up to take Neogen to the next phase of growth. Let me share some financial metrics here for Q3 FY22. Revenues expanded by 56% year on year, while EBITDA increased 41%, translating to margin of 18%, and profit after tax grew by 23%. Our organic chemical business registered a gain of 53%, while growth in inorganic chemicals stood at 70%. Overall, we witnessed favorable demand and firm realization trends across our segments. In a key development, we raised rupees 225 crore through issuance of equity shares on preferential allotment basis at an issue price of rupees 1402.12 per equity share, which saw participation from some of the high quality and marquee institutional investors. The main objective of the fundraise is to support the current growth momentum while capitalizing on the upcoming high potential opportunities across advanced intermediates, custom synthesis and contract manufacturing, and lithium-ion battery material space. This fundraise will make us further ready and help us gain first mover advantage in several emerging demand areas that hold great potential over the next few years. Although the immediate plan is to deploy these funds to repay our debt and strengthen our balance sheet, which can then be leveraged as we invest into our expansion plans. Our new capex announced last year to manufacture electrolyte for lithium-ion batteries advanced chemistry cell is progressing well, and we remain on track to commercialize this by September 2023. Once again, this initiative will help us test the market and reach out to all market players that consume electrolyte for lithium-ion batteries. With the experience of over 3 decades in the lithium chemical sector, we remain confident of delivering a successful initiative in this emerging space. Going forward, establishing our presence here will put us in a sweet spot to capture substantially higher demand for electrolyte arising over the next few years. Post commissioning, both our phase 1 and 2 greenfield expansion at Dahej SEZ are rapidly ramping up. The intention is to focus on niche and value-added products that require expertise in complex chemistry with multi-stage processes, and we are moving well in this direction. Having said that, we are also running our Mahape and Vadodara plants at high utilization levels. We believe all these initiatives will allow us to maintain our business momentum over the next few years. We will remain confident of surpassing our guidance of rupees 450 crore in revenues this year, while the aggregate revenue potential currently stands at rupees 700 to 725 crore, including the expansion and initiatives around lithium-ion batteries, which we continue to target to deliver by FY24. Overall, I am excited with the growth opportunities available for us in chemical as well as lithium-ion battery material space. We will make the right moves at the right time to ensure that we capitalize on this high potential opportunities to deliver sustainable and profitable growth for all our stakeholders. That concludes my initial thoughts. I would now request our CFO, Ketan Vyas, to share the financial highlights for Q3 FY22. Over to you, Ketan.
Thank you, Dr. Hari. Good afternoon, everyone, and welcome to Neogen's Q3 FY22 earnings call. I'm here to share the financial performance for third quarter ended 31st December 2021. All comparisons are on year-on-year basis and refer to standalone financial performance. In Q3 FY22, our revenues stood at rupees 133 crore, representing a strong growth of 56% driven by higher contribution from recently commissioned phase 1 and 2 expansion at Dahej SEZ. This was complemented by 41% growth in EBITDA to rupees 24 crore. EBITDA performance includes an element of transient cost impact related to recently commissioned phase 1 and 2 expansion. Once we run our new plants at optimal utilization levels, this is expected to neutralize. EBITDA also includes some impact of elevated utility costs and other operating expenses linked to COVID-19 related safety protocols. Our profit after tax stood at rupees 10.5 crore, higher by 23%. PAT growth appears moderated due to higher finance costs and depreciation, which is in line with new capacities added during the year. Again, this will improve once the new plants operate at optimal utilization levels. In Q3 FY22, our domestic and export mix stood at 55% and 45% respectively. That ends my opening commentary. I will now request the moderator to open the forum for questions from participants.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Dhaval Shah from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So I have a question on the Dahej phase 1 and phase 2 plant. Yeah. So you already mentioned that we have seen some ramp up in both of these capacity. So can you please share the utilization? I think it may not be meaningful at this moment, but if you can share thoughts on that, and what would be your actual timeline by when we can see the peak utilization from both of these capacities. If you can share thoughts on this thing.
Hi, thanks for your question, Dhaval. So I think both the phase 1 part is now used more, and phase 2 which came afterwards, in which we are also doing some pharma molecules. So this also require some trial production, customer approval, etc. So it is ramping up a little bit slow. Going forward, like I want to start thinking like, okay, the capex was planned in a phase-wise manner, but it's going to be in the same manufacturing block, and going forward in our communication also, I want to just think of Dahej capacity as a whole between phase 1 and phase 2. But yes, right now the phase 1 in which we started making the molecule for agro innovator, so that's kind of already at like 50-60% kind of utilization levels, and the phase 2 in which we did some bromine derivatives and pharma intermediates is still overall ramping up. My guess is with all the approvals and we had to do our audits, etc. For them to happen. So my guess is by let's say mid next year, by let's say September max to max, we should be in a position where we are at full utilization levels. So we will start hitting peak revenues. So if you recall, without the new capex, we were at around 650, 675 crore kind of a revenue estimate which we had originally given before our last capex related in Karakhadi. So that was majorly. So we are going to reach 650, 675 crore based on the Dahej phase 1 and phase 2, which makes roughly around 175 odd crores of 160 to 170 crores peak revenue. So I think we should reach those numbers by at least Q2 of next financial year is what I am targeting.
Okay. So in the opening remarks, I think you mentioned that by FY24, our revenue guidance would be 700 to 725 odd crore, including this electrolyte. But if we are going to reach in this FY23 itself, then I think FY24 guidance we have to revise to upwards, and maybe because I think we also did QIPs of 225 odd crore. So are we going to see capex announcement within some time? Because I think based on our order inquiries, if we are going to utilize optimum by the next year, then I think we should come up with another capex also in Dahej, if I'm not wrong. If you can share thoughts on that also.
Sure. I think, once we hit, so I think there are two capexes, or I would say three capexes which we can potentially consider. One is going to be the larger capex for the electrolyte that we are considering. Then second is, some capex related to the lithium electrolyte salt requirement in the international market. So if you remember, or if you look at our presentations, the opportunities, one is selling electrolytes in India and electrolyte salts in the international. That is the second potential capex, which will be in Dahej. Electrolyte ideally should be in Karakhadi because it's suited for the domestic industry. And the third will be the increase in the organic capacity. So these are the three capex which are under active consideration. And as we keep getting, customer clarity and confirmation, like where we can get certainty of the business, then, we will start basically considering that. Now, at least the electrolyte, you might have seen news that, the final PLI scheme applications were all submitted, I think by 15th of January, the extended deadline, and there are 10 applicants in the PLI scheme. Now, the outcome of this is expected somewhere between March and June, by which time we are also expecting a smaller capacity of electrolyte to start. Like even like a kilo lab kind of a facility to start. So we will also have approval. So I am expecting somewhere between June to September, once there is clarity on PLI, some approvals from customer, that's when we will have a clarity on, let's say, the electrolyte investment in India. So this is my expected current timeline based on today's situation. I personally would feel that first we would like to hit the full utilization level, and then we should be able to see good order visibility of that. So somewhere in the second half, between September to March, which we will be looking at, the decision on the organic capex. So that will be more towards end of FY23. So either third or fourth quarter of FY23 will take a decision on that. And this international lithium salt, again, maybe little bit before June or slightly afterwards, we will take a decision on the international, to meet the international demand of lithium salt. So I think these are three capexes which we are currently considering, and I expect that the timing will be based on what I just informed you earlier.
Okay, and sir, this will cover entire 225 crore, this three capex, or it will be just part of that?
Again, depending on, so again, the reason why we are not doing it is because we don't know the exact size, we don't have the customer commitment, so whether it will be phased out or how much. So depending on the responses that we will get, we will decide. So the capex decision is going to be based on the market, what is the market where we see good visibility because these are very dynamic markets, there are many moving parts, so it will be based upon that. And that will take a decision of, how much capex we are doing now. Normal case, each of these capexes, like if a MPP investment, if we are making, is about 100 crore, right? So my expectations is these would be in the range of 50 to 100 crore individually, okay, in the first phase. So based on that, I don't think, so we will also plan that we're not going to do everything from the equity which we've raised. I mean, this is just adding to our equity, and considering the future potential, there will always be some debt component and some equity component. So while immediately we are using this to reduce the debt and bring our debt equity ratios down, but we are still going to keep some money aside which will go towards margins of this project. So that will be like, we will be carrying cash for a while, and then we will take the optimum decision between using equity and the debt over next 2 to 3 years, depending on the best financial combination which we can come up with and financing. So I don't think, I mean, so again, I'm not saying all 3 may happen. Out of 3, 1 may happen, 2 may happen, depends on how market kind of develops. So, and you also mentioned about, FY24 guidance. So I think, again, our policy has been that the capex that I have or what I've committed today is equal to 700, 725. So unless I have done additional capex and taken a decision of that, I can't say that I will do a capex and then from that additional revenue can come. So therefore, the guidance of FY24 remains on that side. And when it comes to kind of FY23, since we are not hitting the peak utilization, correct, till at least second quarter in the best case kind of a scenario. Also, the electrolyte investment also get fully utilized in the next year. So it will be not full for FY23. Okay. So we'll have a better idea on this, somewhere in our May call when we have the final year view, and once we have a better clarity on, some of the customer approvals on the pharma advanced intermediate sides. So we'll give a guidance on FY23 there. But FY24, that 700, 725 looks doable. This year, based on the run rate which we are doing, crossing 450 seems easily doable. We will be crossing 450. We expect somewhere between, let's say, 475 or slightly above that. So in that range is what we are expecting. But FY23, it should be somewhere closer to 600, but on which side of the 600, I'll be able to tell you, by, let's say, May call.
Right. And sir, this 3 capex you highlighted, so how long will it take to commission? Will it be around 12 months something, or it will be lower than that?
So I think the lithium salt and the lithium salt, if we are enhancing, it will be, in the Dahej facility where we already have a dedicated inorganic block. So that should be 1 year or slightly lesser than 1 year. The organic MPP, generally organic plants are more complex. So I would give like 12 to 15 months. Like good case scenario will be, let's say, 9 months, but I think bare minimum we should take 12 months plus or minus 3 months. And electrolyte, because we are doing it for the first time, my guess would be like 15 to 18 months at least. So that's why, we are targeting somewhere around September, so that we are at least ready by December 23 or early 24, when India demand for the battery is likely to come, based on the PLI scheme initiatives.
Right. And sir, my another question is on these 2 contracts which you got last year. So we were envisaging roughly 60 to 80 crore kind of revenue this fiscal. So can you please share how much of that is recognized till 9 months, and particularly for the third quarter?
So, because there are 2, I can't say that, but it becomes too specific, but yes, whatever range we had given, that together they are contributing in this year 60 to 80 crore, that guidance what we had given continues.
Okay. And my last question, if I may, is on the lithium carbonate prices. So we have seen, increase in the lithium carbonate price. So have you seen any challenges in the inorganic chemical segment, maybe for passing on the input price inflation, or maybe the demand headwinds on the particular this segment? If you can share your thoughts on that.
So I think the real answer of that we will get into next financial year, because as you know, last year, we had given that the prices were historically lows, correct? Now they have come to, like, it's still not yet crossed or just crossed or just crossing in Q4 what has been a historical high. So historically, these prices have gone up to, at least for us, they've gone up to $18-20 per kg. So up to Q3, it was within that, and we were able to pass that on. Of course, today it's too much in shortage, and just because of our relationship, we are getting full quantities or sufficient quantities to meet all our customer requirements. So that itself is a plus. But I don't know whether we will be able to pass on, but sometimes it may create a bottleneck at our customer end, and for them, for example, this vapor absorption chillers, right? They compete against a compressor-based machine. So now a compressor-based machine doesn't have a price increase because of lithium, and if the vapor absorption machine has a price because of lithium, what will be the overall impact? So that's something which we are not able to say as yet. So I think, we will have to see whether the overall volume goes down a bit, at least in some segments, because of such a high price increase. But that the answer of that will be, the Q4, and it's going to be even worse for the next 2-3 quarters, because the lithium prices are likely to further increase, at least till end of this year, after which they are likely to taper off and improve. So this entire calendar year of 2023 is going to be a test of that.
Sure, sir. Sure. Thank you so much, sir, for answering all the questions.
Thank you. Thank you.
Thank you. The next question is from the line of Anshul Verdia from Edelweiss Wealth Research. Please go ahead.
Thank you, sir, for this opportunity. I have a couple of questions. First, on the gross margin. So in this quarter, we saw the gross margin expansion. So could you throw some light? Is it driven by the lower raw material cost, or there is a shift in our product mix?
No, Anshul, I think mostly it's been the product mix, and you've been seeing last 2-3 quarters that our gross margins have improved. So, historically the gross margins, I mean, when I'm talking historically, I'm looking at a very 10-year, 12-year kind of perspective. Neogen used to be between 38 to 42%. Now with this advanced intermediates and some of these CSM molecules we're doing, where we are doing 7-stage, 8-stage kind of chemistry, because of that, the raw material contribution is a bit less, and the processing cost is a bit higher. So what gross margins that you are seeing is like some reflection of that. So what, at least based on whatever I've seen so far, the historical range of 38 to 42 seems to be now more like 40 to 44 seems to be the new quarter on quarter, depending on the product mix, price of lithium, these kind of the range what we are seeing. So I am seeing at least a 2% increase, on an average improvement over what has been historical. Okay. So now I expect 42 plus minus 2% as our, gross margin. But consequently, we've also seen that manufacturing cost as a percentage will also increase, because, we are taking more of the manufacturing resources for achieving the same revenues. So therefore, the manufacturing cost and depreciation as a percentage will increase to some extent.
Thank you. That's really helpful. So one on the EV. So we have spoke about the PLI scheme, the Advanced Chemical Cell scheme, which will be helpful for the companies like Neogen in providing the electrolyte as one of the leading domestic manufacturer in the coming years. So with your initial interaction with the customers, the potential customers, what is your sense on the electrolyte market as such? Because time to time we have seen the shift in the technologies. Now people have started talking about the sodium-ion battery. So is this something a risky territory we are foraying into, or what is your views from the initial interaction you had with the customers? Because even the people who have applied for the plants for ACC and the PLI, they are not sure of which technology would they be using. So any initial thoughts that would be really appreciated. Thank you, sir.
So again, the currently, at least based on our views, and I think what we discussed a little bit also in the last call, that for EV applications, so there are two major applications of these storage batteries. One is, two large applications. One is the EV, and second is, storage for renewables or intermediate storage for, let's say, hydrogen production. So when you are talking of intermediate storage for hydrogen production or let's say storage for let's say renewables, that is where a sodium ion battery can have an advantage if it becomes efficient, because these are static systems, and the charging of these batteries happens over a period of time. So it's not a very fast charge, fast discharge, and the performance and the weight of the battery is not critical. To the best of my understanding, for EV, lithium-ion battery is going to stay. Now, within a lithium-ion battery, there are different cathode chemistries, and depending on different cathode chemistries, there would be slight variation in each customer's electrolyte composition. So the salt which they choose, or the additive that they choose, or the stabilizer that they choose, so will be customized for each customer. But the basic requirements remain the same, for the electrolyte, as long as we are talking of lithium-ion batteries application. So I think, at least in my understanding, the kind of electrolyte which we are making is going to be required, irrespective of the lithium chemistry which they choose. I think, again, ACC also has some battery performances that you have to have some gigawatt hour per kg performance, or sorry, not gigawatt hour, so some cell kilowatt hour per kg, and some performance parameters are there. So I think, based on my understanding, most of these are going to be lithium ion batteries. Of course, sodium ion will be there, but lithium ion continues to be one of the key technologies, and the demand for electrolyte is still going to be significant. Of course, the reason why we've not yet done the final investment is because we are waiting also for clarity. And, at some point of time, like I said, by June, our customers will be, by June or maximum September, our customers will be making this decision. And as our customers make decisions and we get comfort from them and they get comfort on the developments that we do, we will go ahead with that. So that's something we'll keep watching.
Thank you, sir. That's really helpful. Just last couple of ones on the modeling side. So we saw the other expenses increasing, almost doubling this quarter, and also the increase on quarter-on-quarter 30%. So in your initial opening remarks, you said it consists some of the COVID-related protocol, some cost on the transient cost. So can you quantify COVID-related protocol, and is there any component of QIP raising, the cost related to QIP raising in that, which is not a one-off for the next quarter?
No, so there is no QIP raising cost, but more or less, let's say, the capacity that we have today is good enough to do 165, 175 crores worth of revenue, correct? So it's kind of almost double as compared to what we were doing earlier. So that's one of the criteria that, okay, most of the capacity has come in place, while we have not yet reached full utilization level. But people and some of the maintenance systems, QC, R&D systems, all of those have already come in at the full level. So as the utilization improves, as a percentage it will drop. And the second reason for increase is what I have shared with you earlier, that our the product mix is such that, let's say by 1 or 2%, our gross margin has improved, but at the same time, the manufacturing cost has gone higher.
Got it, sir. And lastly, on this interest cost, so this will continue with the run rate going forward. This quarter we had little higher interest cost.
So the interest cost again should improve because of the fundraise that we did. But I would ask Ketan to maybe give a better idea on that.
Yeah, as we did our fundraise and the funds have come in, we try to deploy the funds to optimize the finance cost. While we looking at let's see what best rates we negotiate with the banks. to optimize our interest cost and use the fund that we have to lower down the working capital cost that we have and park off some of the funds to gain some interest while the capex plans get finalized in coming quarters. So we do expect that we should have a better lower interest cost in the current Q4 quarter.
Thank you, sir. That's all from my side. Thanks very much.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Manish Jain from Money Life Advisors. Please go ahead.
Yeah, thank you for the opportunity. My first question is, what is the traction you're witnessing on the custom manufacturing business? Or have you added any new projects or customer under this segment?
We've added new projects, but those are early stage projects. So we've not added what other than what we had commercialized. So we've not yet signed a multi-year agreement, if that's the question being asked.
Okay, any new inquiries from the customers?
We keep getting new inquiries from customers all the time. Also, as we had informed earlier, once our Dahej site is fully commissioned, and we are also in the process of getting this quality certifications completed by this quarter. So once these are completed, we have in parallel also started approaching some key large customers who we were holding back because we did not have the site, SEZ site fully ready at that time. And also, the availability was also a question. So now with Dahej ramped up, having some extra capacity, we have started approaching these clients. But again, these take 1 or 2 years to develop. So I think between now and, as I mentioned, next year Q3, Q4, we will have a clear idea of what the pipeline looks like beyond FY24, and what happens in this 1 year is going to determine so how many of the existing molecules are kind of ramping up, and the new customers with whom we are discussing what is the potential volumes of this is what is going to allow us to take the decision on the next capex in the MPP in Dahej.
Okay. Secondly, can you provide some insights on how you're planning to utilize rupees 225 crore raised through the preferential issue of shares?
So I think initially we will be paying off, our rupee debt, because we also get export funding, which is at low interest cost, lower than what we can even get normally. The remaining we would pay off, and some of the term loans we will pay off, which anyway have a maturity in next 1 or 2 years. Those will be paid off, and then remaining additional money will be deployed, will be kept as a cash in the form of an investment till our further capex plans get formed up.
Okay, thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Saurabh from Asian Market Securities. Please go ahead.
Yeah, thank you for the opportunity. So I just wanted to understand more on the electrolyte thing. So based on your comment, is it right to understand that you'll be working on 3 or 4 types of salts with the different customers?
So different customers might not have the same, they may have different salt or they may have the same salt, but generally salt, solvent. So there are 3 major parts, right? Salt, solvents and additives. So the combination of these, how much of salt, how much of solvent, which additive, that remains different for different customers.
Okay, and what about the additives? So are we also looking at making that as well?
Yeah, so if the additive is a lithium-based additive, then yes, we are looking at making that in-house. Some are a non-lithium additives where we will take a call whether it makes sense or whether it makes sense to just buy them.
Okay. In your last call, you mentioned you're also working with the international customers. So is there any further progress in terms of export opportunity for the electrolyte?
Yeah, I mean, we are evaluating that, but as I mentioned, we want that small facility to start with, which we can start working with the customer. So the customer does remain interested, and we are exploring. Although I have to say, the international customer is the main interest is that he will also eventually tie up with somebody in India. So once we've done the evaluation, whoever he ties up in India has a already approved source. So again, how much he will purchase internationally or more he is interested for whatever they are planning to do in India is something which time will tell. But electrolyte inherently have some challenges in shipping, like some disadvantages if you are shipping it very long, because the tanks which are required or the containers required are very specialized, and you need to bring them back and forth. So, then the cost of doing internationally sometimes can be higher. Again, if they don't have a domestic source with enough quantities, they may still do it as an option. But like my personal feeling is that majority of the electrolyte business will be domestic.
Okay. And no, just maybe broad comment on next 3 to 5 years time frame in terms of investment. So are we looking at higher capex outlay on the electrolyte or EV part of the business, and probably organic capex will be maybe 20-30% of overall capex?
So I wish I can answer you that, but I think, when it comes to capex, it just makes sense to take one decision at a time, in our view. And, it's too early to predict. So we have opportunities in both the segments. So each opportunity we will take, what are the risks associated with that, what are the opportunities in front, and, that will be the main driver for capex. So I think it's too early to predict how much will be lithium and how much will be, the organic. Oh. But one thing I am certain that there will be investment into both. Percentage seems difficult to predict now.
Oh, and all the capex maybe over next 1.5 years. So is it fair to assume that earliest this capex can contribute is second half of FY24?
No, so I mentioned the capex decision is going to be taken, let's say, earliest, out of 3 capex which I mentioned, the earliest can be June, for example, and the maximum would be, let's say, by Q4 FY23. So that's when we will take the decision, and majority of this will come online, let's say, in FY24. So FY25 is when they will contribute. Depending on timing, some of them may contribute in FY24 also. Let's see. So if these capexes, for example, if it happens, let's say by June, we can get it to contribute in FY24, that will be great if the visibility and the clarity is there. But most likely the major contribution or significant contribution will be in FY25 onwards.
Okay. And so just last one on the other expense. So you mentioned maybe as percentage of revenue will come down. So can you give maybe what is the breakup of variable and fixed cost of the other expense?
That's a bit difficult to do, but as I mentioned that, on a steady state basis, once we have full utilization, I am currently expecting for example, 2% improvement in our gross margins. So at 42% and 2% increase in other expenses, more or less, right? Over what was kind of a steady situation, let's say last 2-3 years. So remaining more or less EBITDA neutral. Of course, if we are able to do better than that, then that's where the EBITDA margins will improve. And as I've said earlier, one of the major driver of that is going to be the innovation that we do or some higher efficiency which we achieve as compared to what others have done. So I think once we start doing this stabilizes, innovation kicks in, improvement kicks in, that's when we can basically see further improvement on that. The only variable here I would like to say is the lithium prices, because the way lithium prices are growing very high, on the absolute margin, the margin levels, there might be some impact there. Depends on how high they go, and like I said, sometimes we'll also have to support our customers in this very demanding 3 or 4 quarters, which is going to be there. So depending on that. But otherwise, like my expectation is like a 2% improvement in gross margin, 2% increase in other expense on a steady state basis, and then any innovation will help us go beyond that 18-19% EBITDA which we usually consider.
Okay. Sir, any price hike taken in our organic business?
So yes, some of the raw materials have been increasing, and because of those increases, we also have been passing on to our customers. So like solvent prices have increased, bromine prices although have increased, but so far because of our long-term contracts, we are on an average the impact has been very limited, which we were able to cover. So the more impact of the bromine price hike will come in the next financial year when our contracts will reset, and we'll also have to reset with our customers.
Okay. Thank you for your time.
Thank you.
Thank you. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
Dr. Harin, India has such aggressive plans for lithium ion, but
Yes.
from a supply side perspective, I mean, has India tied up the amount of lithium we will need to import?
So India as a country has not tied up. Individual players like Neogen or whatever Neogen is planning to do in lithium, we've talked to the major lithium guys, and we are quite confident, at least for the electrolyte or the lithium salts that we are considering for international market, we should be able to get. Although the big demand of lithium is going to be in the cathode side. So the cathode requires much larger lithium as compared to the lithium which is present in the electrolyte. So some of the companies in cathode, and Neogen is also exploring some cathode chemistries. That is where we'll be more worried about, will we get enough lithium? Now, again, the way we see it, so the good news is that India is starting in 2024, and the major demand where we become a significant player where, we have to worry about, will we really get, we become a bottleneck or decision making for the world lithium is not going to be by, FY26, 27 or maybe 28. Because the world lithium capacity is increasing so much that, we should be able to get some share of it. How competitively we'll get, time will tell. And I think government of India also has set up a particular company, and they've taken some initiatives to, as a sovereign nation, to secure the materials, to secure lithium for India, so that companies like Neogen can then tie up with company. It's a concept similar to like ONGC Videsh, to kind of give you the most easiest example. So I think there is some action on that front by the government. Again, I hope, I know they are also working very hard, and I think by the time it becomes critical, if everything goes well, these, like as a sovereign nation, we have done something to secure lithium. Otherwise, we will have to kind of step up, and each individual company will have to go and secure its lithium from internationally what is happening.
But say for Neogen right now, if you are putting up capacity, you would have tied up back-to-back long-term arrangements for supply.
Yes. So when we will set up a capacity for X or whatever capacity X that we are planning, the lithium which will be required for that. So we've talked to the existing lithium suppliers, and they are confident that they can give to us that material. So lithium will not become a constraint for us for the plans that we have so far.
Okay. And this first phase that we're doing, 250 metric tons, at steady state, what's the revenue potential of this?
So, this 250 metric ton is going to be really trial volumes. Okay. So therefore, it doesn't really make, so again, this 250 metric ton is, not, I would So the prices will be, because we are doing a smaller quantity, the lithium prices will be different. So I would not want to put a number on that at this moment. Okay.
Yeah.
So as we said, the 35 crore capex was both for this as well as for the pilot facility where we can, make like the initial requirements of international customers in the CSM business, and together they will contribute 45-50 crore. So that's something which we think we can achieve. And let's say even if some of the revenue doesn't come from here or it's a bit lower, that's something which can be absorbed very easily with incremental capex in my existing facility, or just like better utilization of my facilities and stuff like that. So therefore I would not like to put a number on the 250 metric ton. It's more essential as getting approval, demonstrating, and the knowledge, to gain knowledge so we can design our larger capacity, which will be at least couple of thousand tons more efficiently.
Okay, so let me rephrase my question, Dr. Harin. In slide 18 of your presentation, you have a chart which you say that the electrolyte demand for India will be 70,000 metric ton as per the estimates given, right?
Yes.
Right? So let's say that the electrolyte demand of India is 70,000 metric.
Yeah.
Let's for a minute assume that Neogen is only supplying 10% of that, right?
Okay.
So if we say for a 7,000 metric ton capacity, what is the revenue of that then?
So Manishji, for various reasons, I don't want to name the value of that. If I wanted to, in the same slide, I could have done a comma and added the number, so it becomes easier. But one is, because lithium prices are moving so much, still not like very clear clarity of what is going to be the composition of this 70,000 metric ton. So although I have the number with me very clearly of the range, but currently I'd not like to share if it's okay.
No, absolutely, sir.
The
intent is not to put you on a spot.
If you just Google electrolyte prices, worldwide, or there are some research reports also which kind of give you that. Again, some of them are on a lower side. That's what we believe, and that's why we don't want to put a number till we understand. Also, the price of this electrolytes in China is very different, in Japan it's very different, in Europe it's very different. So what's going to be the India one, and that range is also quite a bit. So that's why I don't want to put a number on it as yet.
Okay, thank you very much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. For any further questions, you may come back for a follow-up. The next question is from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. Congratulations on a good set of numbers. So my first question is, on the electrolyte capex. So you mentioned that it is around 50 to 100 crores probably in phase 1. What would be the likely asset turns out of this capex?
Again, sorry, I don't have an accurate number for you as yet. As I said, because as I answered in the earlier earlier answer also, that the exact composition which the customers are going through, what is going to be the price, still these numbers are varying quite a bit, and although I have a approximate number in mind, also exactly what capacity which we are going to put up. So we can put up, let's say, considering a 10% market share, 20% market share, 30% market share, or we can put up a capacity for 3 years versus 5 years. So a lot of these questions still need answered. So unfortunately, I'm not able to answer at this moment. My guess is generally inorganic inorganic capex is usually having better asset turns than organic. So if in the organic we are able to achieve 2.5, my guess is it has to be better than that. based on whatever, but how much better, whether it will be same or better, that's something, I need to be more sure of some of the details. Only after that I can share.
Sure, sure. Only other thing, a follow-up to that is, if you can probably indicate what would be the, capex per, let's say, 1,000 metric ton, or I don't know, what figure you are looking at. But if a ballpark figure, if you can, give us that what would be the capex per, 1,000 metric ton capacity. So that would help us.
So most likely the capacity, because the existing one itself will be 250 metric ton. So the capacity that we will set up will be at least couple of thousand metric ton. It will be more than that. Again, unfortunately, I don't have a number on that yet. Please allow me. I hope by May I can give you, in the next call, I can give you better clarity on this. Case scenario, definitely the call after that. So July, I think we should have a much clearer answer on that.
No worries. Thank you. Next question is on the capex side. So you mentioned 3 areas of capex that currently you are thinking of. So one is electrolyte, the other is salts for international customers, and third is inorganic.
Third is organic.
Third is organic. Okay. Okay. So that is where actually my question is coming from is, so probably our organic chemical capex would be fully utilized by FY24. So, what is the plan over there, and what is the, again, probable quantum of capex you are looking at?
Sure. So I think, as I mentioned earlier in one of the answers, as you very rightly said, in FY24, we expect to be fully utilized condition. So somewhere in second half of FY23, we should be making a decision. Most likely, I would say in Q4, taking a decision on the organic capex. If the demand remains very strong, we have good business visibility, etc. So that, that if we take the decision by, let's say, even if we take the decision by end of FY23, so by end of FY24, we have a new capacity which comes online, which can help us continue our growth in FY25. Generally, my expectation is it will be somewhere around 100 odd crore of capex, with again 2.5 asset turns, which we should be doing. There usually it's an incremental capex, so I think we should be able to do that in the hedge. But again, more precise numbers we can give you at that time, but this is my general expectation.
Understood. Last bit on the other expense side. So is there any element of elevated freight cost and the high utility energy costs also impacting the margins?
Yes, to some extent. But of course, I would say the bigger driver is just the utilization. So as we improve the utilization levels, again, it's still within the range which I always mentioned, right? 18% plus minus 1%. So we're still there. Maybe not on the higher side of it, but I think yes, freight has been higher, but again, I think most of that we've kind of passed on. Fuel prices have increased. It will take some time for us because that's not something which we anticipated, and it will take some time. But the contribution of that is there. But in my mind, it's more my Dahej plant getting fully utilized and utilized efficient manner. So the efficiency and the increased utilization levels is what is critical for us to improve. And some of that, as you've seen, it's not, maybe the comparison it directly looks double, so it becomes more stark. But if you look as a percentage, it has been increasing because of the product mix already, as I mentioned earlier.
Understood. Thank you. Thanks a lot. That's all from my side.
Thank you. Ladies and gentlemen, we take the last question from the line of Mihir Damania from Ambit Investment Advisors. Please go ahead.
Yeah, hi. Am I audible?
Yes, Mihir.
Yeah. Are we maybe looking at any inorganic acquisitions?
That's my first question.
No, I mean, historically what we have stated same remains, that normally our growth strategy is not through inorganic. Inorganic, if at all an opportunity comes in front of us where we think it can add a lot of value, we are always open to consider that. But usually Neogen's plans are more organic growth, and the fact that we have land available both in Dahej, Karakadi, we already have approvals, unless there was a specific reason, we would not think of an inorganic growth. I mean, acquisition or something like that.
Got it. Thanks. My question is more on the fundamentals. So fundamentally, on the scale.
Excuse me, this is the operator. Sir, I'm sorry to interrupt. Your voice is breaking.
Is it though?
So it's still breaking.
How better?
Yeah, a little better. Let's try. If we get the entire question, then that's good.
Yeah. So, my question was mainly on fundamentally on the initial assessment. How does the electrolyte opportunity on the margin front? So I'm not looking for guidance or something like example, but I just want to understand how it stacks up compared to what our other segment is. So will it be more of CSI margins, or will it be more of the advanced intermediates or organic chemistry, or maybe even better or worse off than each of these segments? What is your initial assessment on that?
So, again, as I mentioned, because the exact mix, complexity, and, even the plant investment is still not yet clarified. It currently, there is no current answer to give you exactly how the margins are going to change for the electrolyte. However, the expectation is that the margins could be lower as compared to organic, but expectation is that the asset turns will be better, and let's say on a ROE or a ROC basis, they will be equal to what we would see in incremental capex in organic. This is just what I would wish for, or if I were to put my model, that's how I would put it in my model. But again, it's too early to give you more clarity on that.
Got it. Thanks. That answers my question. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you all the participants for joining the call. I hope we were able to respond to all your questions. If you have any further questions, please feel free to contact our investor relation team, CDR India, and we will address them. Thank you once again. Stay safe, and we look forward to connecting with you in the next quarter.
Thank you very much, sir. Ladies and gentlemen, on behalf of Neogen Chemicals, that concludes this conference. We thank you all for joining us, and you may now disconnect your line.